Now we're going to have a breakdown on Europe and just some of the things that are happening on the inflationary front. And it's important to look at this holistically. So industrial production, as we talked about it in September, went up a bit, but we expect that to drop off fairly aggressively when you look at October based on PMIs, some of the leading indicators, because the industrial production, the way they have it, is a bit lagging. Survey expectations came in a bit better. They were expected to be, last month they were at 59.7, came in at 38.7. So again, like you're still in contraction, you're just contracting a bit less. So I think that there is some different pieces that are a bit better for us going forward. But you're still in a problem, and I don't see it improving all that much, especially as the job markets adjust a bit and inflation actually accelerates once again. Trade balance came in a bit better than expected, but still negative. Employment slowing down, as we were saying, quarter over quarter, year on year. GDP for Q3, at 0.2. We see downside risk for this year, for this quarter. Construction output, again, still lagging, but then CPI was expected to be at 10.7, came in at 10.6, but last month it was 9.9. CPI month over month came in right at 1.5%, core right at 5%. But when you break it down into its pieces, and I think this is a really good breakdown of the different data sets, you can see Euro area core. All of this is still up and to the right. So they got the detailed Euro area HICP report for October, and contrary to the US, there is no sign of the peak inflation, and that's even before we've actually had any real heating demand in Europe. So as heating demand picks up, just again along seasonal lines, I'm not saying that they're going to go into a deep freeze. It's just you're going to see more pressure behind the diesel side, more pressure behind natural gas, more pressure behind electricity, which is going to move a lot of these indicators higher. If anything, price pressures kept broadening in October with a larger number of HICP items rising faster. And I think that's the key piece, is you actually had a reacceleration in October. And this is with unseasonably warm weather. What happens if you get into just normal winter weather? What is that going to do for the price appreciation, which is why we see more upside risk, more inflationary pressures as we go into November and December. And if you remember, we've been saying for some time that Europe was behind the US. The US inflationary spiral started before Europe. And now we're seeing that acceleration point, and they're still behind us. So there's still more to come when you're looking at the inflationary push, which is why we expect the ECB is going to have to respond aggressively, not any more aggressively than the Fed, but they're still really far behind where the Fed is right now, and they're going to need to see this push, and they're going to have to respond aggressively. And then when we look at the Composite PMI quarterly, again, moving further negative, which is why when you look at GDP, there's all of these different capacity points that show a movement lower. As China reopens, there's a hope that you're going to see more credit impulses, and that's going to be a positive for the euro and European trade. And one of the things that we've been cautioning on, we talked about it, I think it was 2 or 3 weeks ago, we had the chart on credit impulses just are diminishing. We're not seeing the same growth levels, and that's why we see a lot of these pressure points. The employment is cooling. Employment continues to slow, and we see that not really accelerating in general and putting more pressure on where some of these things are going, how this is interacting, and why we see, again, the consumer slowing even further in Europe, which is going to put even more pressure on the underlying economy. Breaking it into the two key pieces, so CPI in Germany, fairly in line. When you look at wholesale price indexes starting to come down in October, survey expectations were expected to be at negative 51, came in at negative 36.7, but current situation was expected to be at negative 69, was at negative 64. So still concern on where this is going, how the world is headed, especially on the German front. In France, wages came down CPI came in at the elevated level, and you're still seeing, again, a lot of this pressure to the upside with a lot of these additional components not even fully factored in. Eurozone industrial production, when you look at it, ex-construction has started to move up, but when you factor in industrial production, energy-intensive sectors have been moving down. So this is the bifurcation that we're seeing, where energy-intensive companies and assets continue to be under pressure, and with where natural gas prices are and where coal prices are, power prices, we see more of those levels of extremes continuing to carry on into the end of the year. Eurozone CPI year-over-year consensus, according to Bloomberg, 5.8%. Then GDP growth is at negative 0.7. So when you look at these extremes, we're just essentially sitting here saying that inflation is going to outperform. It's going to go above estimates. And then GDP growth for 2023, given this is just a projection, is going to be well over 1% to the downside, which is going to, again, put more pressure. And it's really going to be driven because inflation is going to go up, and we expect to see an inherently bigger slowdown when you look at what that looks like. And you can see that they continue to get worse over time as the new data comes out, and we're not seeing that peak yet. And we continue to see now employment slowing and all of these other pieces that are going to weigh on just what those GDP expectations are going into next year. And then substantially less new mortgage contracts, not surprising. And then Germany is stuck choosing sides. Monthly German trade balance with the U.S. Is at an all-time high, and then with China is at an all-time low. And that is some of the extremes, because we're not seeing a lot of that trade coming into the U.S. the same way. A lot of that is slowed. A lot of that is high-value stuff going to the U.S., and those are some of the extremes and the pressures that we're seeing on their trade balance, why their trade balance has moved so steeply negative. And we don't see that changing anytime soon, which again is going to put more pressure on a country that is very much an exporting nation. So I know that's brief. There's not much to say outside of what we have. We've been pretty spot on when we're looking at Europe. And in the next segment, we're going to go deeper into China and the Chinese data, as well as India, because there's a lot of problems that continue to crop up when we're looking at what is happening on the Asian continent.